Hello, Billy FS here. And in this video, we are going to talk about supply and demand in details, how to actually trade them profitably, some trades and hacks you can actually use to increase the probability of a supply and demand zones holding, and some pitfalls that you should avoid. So if you haven't subscribed to the channel, make sure you do so to help us grow the channel. And if you have any questions, you can definitely leave them in the comment section and I will come and attend to you personally. Let's get straight into the chart. When you look here, we have a candlestick pattern, which is the bearish engulfing candlestick pattern, which is also the same thing as this candlestick pattern over here. Essentially, the bearish engulfing candlestick pattern is just a bearish candle taking over a bullish candle. It doesn't have to be a single bearish candle. It can be consecutive bearish candle. The most important thing is that we have a bullish candle which has been totally engulfed or covered by the bearish candles. Now, you might be asking me, why am I talking about supply and demand and showing you candlestick patterns? Because they essentially form the basis of supply and demand. Since we are talking about bearish engulfing candlestick over here, we will be looking at supply, but everything that you see for the supply inversely applies to the demand. So, a demand zone or a supply zone is simply, for a supply zone, it is simply a candlestick which is bullish that has been covered by one that is bearish. Simply a bullish candlestick that has been covered by a bearish candlestick. That forms a supply zone. So if you want your zone, you just pick a line, put it at the low of the bullish candlestick, then everything above the line becomes a supply zone. The same thing applies to this one. We have a bullish candle, then we have consecutive candles trading below the low of the bullish candle. So if you want your supply zone, you take a line, you put it below the low of the bullish candle. Everything above that line becomes your supply zone. That is just a supply zone. So when you flip the chart, you can say the same thing for a demand zone. So for in this case, we are going to have a bearish candle here, and this big red candle is going to be a bullish candle. So here we are going to have our demand zone here. Here we are going to have our demand zone over here. Now, before you go into the chart and look at more examples, I have to tell you about breaker blocks because we cannot talk about supply and demand without talking about breaker blocks. Sometimes the market will not come deep inside the supply and the demand zone. It will just use the low of the bullish candle or the bearish candle, then drop. That is when breaker blocks are mitigated instead of the full supply and demand zones. It is literally something that you have to understand to prevent yourself from missing out on a lot of entries that would have been easier if you knew about breaker blocks. So let's look at the supply zone, how the market is going to mitigate them before we move down into the what? Into the breaker blocks. Now, for this one, if the market is supposed to mitigate the supply zone over here, we are going to have something like this. We tap into the zone, then we drop, right? Then the same thing applies to this one. Trade down a little bit, we come into the zone, mitigate it, then we drop, right? So if you want to take a short from here, it is just your short to position here. Your stop loss must go above the high of the what? The supply zone, something like this. Then you can target a face ratio like 1:2, right? Or you can target 1:1, 1:5, or maybe draw on liquidities, however you want to what? Take the trade. So your stop loss must come above the high of the supply zone, and your TP must be a face ratio, 1:1, 1:3, or maybe a point of liquidity that you want to target. So this is how you would trade the direct supply and demand zone. Now let's try to include breaker blocks. Now over here we have the same pattern that we had before, but I have made a little bit of what modification. In this case, for the first part, we have first of all a bearish candle, then we have a bullish candle taking over that bearish candle. So what do we have? We have a demand zone. Don't forget, a demand zone is simply a bearish candle being taken over by a bullish candle, and a supply zone is just a bullish candle being taken over by a bearish candle, right? It shouldn't confuse you. It's just engulfing candlestick pattern. That is why I started with that to make it extremely simple for you. So we pick a line. We mark the low of the bearish candle. In this case, since you are talking about demand here, you have to mark the high of the bearish candle, right? You mark the high of the bearish candle. Everything below this bearish candle becomes what? Demand. So let's acknowledge that with this rectangle tool over here, right? So everything below this line becomes what? Demand. Okay. Now, the market under normal circumstances is supposed to mitigate the demand and what? Rise up. But in this case, we don't have something like that. We have the market creating a huge bearish candle covering this huge bullish candle that was formed to create the demand, creating a supply in the inverse what scenario. So how do you mark the supply? You take a line, you mark the low of the bullish candle that was what? That was broken, right? So in this case, there demand is no longer there, then we have what? We have a supply. Okay. So if the market is supposed to, continue the downward trend, something like this is most of the time going to happen. The market is going to trade up, but instead of diving deep into the supply and mitigate it above here, it is going to use the demand that fold, right? You see, a demand was created over here. It was supposed to hold, but it did not hold. So this demand that fold is most of the time what is going to be used. The market is just going to mitigate it and drop. So if you are positioned over here, if you position for a short over here and anticipate that the market is going to dive deep inside the supply, then you are going to most of the time be left out because the market is going to mitigate a breakout block. Your stop loss should actually be above the high of the demand that fold, and your TP will be something, maybe a draw on liquidity that is lower to increase your risk reward ratio even, right? So you should understand breakout blocks. If you don't understand them, you miss out on a lot of what trades. Same thing applies to this scenario over here. We have a demand zone that has filled. You can see the demand zone. You have to use the definition. It's just a bullish engulfing candlestick pattern. Nothing more, nothing less. Do not complicate the thing. Trading is already complicated. The more you try to complicate it, the harder it becomes to actually what master it. We have a bullish engulfing candlestick pattern, creating what? Creating a demand. The market was supposed to come to the demand and hold and trade up, right? Right. So after we trade up, under normal circumstances, we are supposed to have something like this, but the demand was hold. But the demand did not hold. It actually broke below the low of the price broke below the low of the what of the demand. So it created what? It created a supply, right? So the market is supposed to mitigate the supply and what? And drop. But in this case, it is not directly going to mitigate the supply. It will actually mitigate the demand that field using it as a breaker block and what? And drop from there. So something like this is most of the time what you're going to have. So you short the market from here, the stop loss goes above the high of the what? The high of the demand, and your TP is going to be a fixed risk reward ratio like 1:3, or maybe a target on a draw of liquidity. So now that you understand supply and demand and breakup laws, let's go to the chart. So let's look at Nasdaq because I have the examples on Nasdaq here. Nasdaq. Yeah. Now, if you look at the chart over here, let's start on a 30 minutes time frame. Now, on a 30 minutes time frame, for the first example that I have, you can see I have a bullish candle, right? Then I have consecutive bearish candle coming down. Can you see them? Consecutive bearish candle coming down over here, trading below the low of the bullish candle. So I just took a horizontal line and I marked the low of the bullish candle. So everything above this bullish candle becomes a supply. So when the market comes below that bullish candle, I can what? Sorry, above that line over here, I can just short the market in anticipation that the market is what's going to drop because that area becomes what? Supply. And I'm going to target maybe 1:2 or 1:1 based on how the market strategy is what's behaving. You can refine this on the lower time frame for more precision, but you are not talking about refinement over here. We are talking about direct supply and demand what zones. Now, you can see that the market actually did not trade deep inside the supply before it dropped. Now, why? Because we can see a series of what? Bearish candle over here, which were aggressively traded, they were aggressively covered by this what? Bullish candle, consecutive bullish candle. So that area was an area of demand that was supposed to hold but failed. So that became what? A breaker block. So instead of trading deep inside the area of what? Supply, the market rather used that breaker block to what? To drop, right? So if we knew about breaker block, we could have at least positioned for a short somewhere around the low of the breaker block. Our stop loss goes above the high of the breaker block, then our TP maybe 1:2 or 1:3 or 1:4, right? So that is as simple as that. Now let's go to the chart to look at the other two examples that I have over here. So for the first example, we have this candle. So you can see a bearish candle over here. That was totally engulfed by a bullish candle. A bearish candle totally engulfed by a bullish candle. So we have a bullish engulfing candlestick pattern. That becomes an area of demand. So we mark it. Anything below this line becomes what? Becomes what you call a demand, right? So we mark the zone around this area. So everything here becomes a demand. So you wait for the market to come here, then we literally what? Buy. So you could have just what positioned for a long over here. Sometimes you have to wait for confirmation, right? Because the fact that it's a demand doesn't mean that the market should buy from it directly. Sometimes it should trade a little bit towards lower. So if you take a direct entry, you might take a stop loss, but it ensures that when the market comes there, you get fooled. Like for instance, if you're waiting for confirmation over here, you'll not be fooled exactly at a place. You'll be fooled somewhere around here because the market just used a wick and it left no other option for you, but just to come and find confirmation around here before what you buy. So here you leave a limit order over here, then you buy, maybe you target the next draw on liquidity, that is the swing and that is sitting right here. Hope that is clear. This one is a direct one. Now let's look at around this zone over here. After the market has started within this zone, we had a little bit of confirmation over here. Now, if you look at the chart that is sitting right here, you can see we have a bearish candle, a huge one, but it was completely engulfed by a series of what bullish candle. So it means that this area became an area of what demand that the market can come to and what rise. Okay. Now, this area of demand, the market didn't actually trade into it deeply before rising. Why? Because if you move on to the 15-minute time frame and you actually check, you can see this bullish candle, which was totally engulfed by this bearish candle, right? So it was an engulfing candlestick pattern. It wasn't a direct one, but with a consecutive candles type, this is what we have. A bullish candle totally engulfed by this series of bearish candles sitting right here. So literally or essentially, we don't have a direct demand zone, but rather we have a breaker block, right? We have this breaker block that is sitting right here. The market came into the breaker block, mitigated it, and what kept rising. So if you knew about breaker block, you should have positioned there. But if you think maybe supply and demand zone, that's what the market is going to come to always, you will be positioned somewhere around here and you'll miss the trade. Most of the time, you won't miss the trade. So this is what you were supposed to do. You long the market from here, then your stop loss goes above the low of the demand zone. You target maybe the swing high that is sitting right here, right? You target the swing hand that is sitting right here. Don't forget your stop loss must be below the low of the breaker block. People can put their stop loss here, but it doesn't make sense. Put it at the low of the breaker block and target the swing high or the draw and liquidity that is sitting next to next to the chart. So that is just about it. Now let's look at some tricks that you can actually use to actually increase the precision of the zone. Now, this is an external something that you have to consider because price does not mitigate and rise from any random level, right? Institutions they enter at precise level, and those levels are psychological levels or round numbers most of the time. That is why I have this indicator over here that says round numbers, right? So it means that if you want to position, you can position exactly on a round number. You can see this faded line over here, faded dashed or dotted line over here. You could have place your limit order on that line, exactly on that line, because price most of the time mitigates or use those lines before it starts moving in the same direction. If you don't understand psychological levels, I think you can do a little bit of research on it, but it can actually help you to actually increase the precision of your entries. Now let's look at the one that we have below over here. You can see we have a psychological level, that's the blue line over here. So it tells you that you can position for a long in this area that we were already looking to long the market by using these psychological levels. That's increasing your risk reward ratio and increasing the probability that the market will actually move in your direction when it shows rejections at that level. Now let's look at the first example that we looked at, and let's see if we had a psychological level there that we could have used, right? So this was the area that we were looking at. We had this area of we had this breaker block that we were trying to short the market from. So we had a lot of psychological levels on the breaker block. In this case, you can choose to use any psychological level on the breaker block that you like. But if you think you use the first one and the risk reward ratio is bad, you can use the second one. And if you think if you use the third one, the risk reward ratio will still be good for you, you still have to use it, right? Let me try to short the market from here. And if my stop loss is here, the risk reward ratio will be very bad. But if I try to short on the second psychological level or within the breaker block, my risk reward ratio will be a little bit good. But if I try to short at the extreme, I might not be tapped in. So you always have to know the trade-offs and how to actually get into the trade. So these are some tricks that you can actually use to increase the precision of your entries and also increase your risk reward ratio. And for the pitfalls, you literally have to understand something extremely important, And that thing is based on the fact that there's a breaker block doesn't mean that the market should mitigate a breaker block before it drops. Sometimes it is going to mitigate, the extreme supply zone before it drops, or it's just going to use the breaker blocks before it does what? It drops. All right. So when you take a loss from the what? From the breaker block, do not try to take another entry, assuming that the market didn't just use the breaker block, it's just going to use the extreme supply. Because if you think about that, you can literally be what? You can literally be taken out. Maybe the market is not actually going to mitigate the extreme supply, it is actually what? Reversing. Okay. So let's assume that we have something like this. So the market came into this zone, didn't drop, right? Then you took a stop loss, right? Then you thought, okay, maybe this is the extreme supply that the market is going to what mitigate. So you position for another short, then you get another what stop loss, not knowing that the market is actually what reversing instead of what turning. So if you take a stop loss on a breaker block, do not try to re-enter the market until we have confirmation that maybe the mitigation is over and you want to actually what short the market. That is what you should actually know when it comes to supply and demand zone. Very simple, very mechanical. Supply and demand zones are nothing more than bullish engulfing candlestick patterns and bearish engulfing candlestick patterns. You can go to the chart, look at more examples, and understand it better for yourself. All right, see you in the next video. BDFS out.